Yo, what's up YouTube? My name is Paris Clough and this is Financial Self-Reliance. I'm super excited to share with you a step-by-step guide to maximizing your dividend profits and making sure that your dividend portfolio is moving in the right direction. A strong financial plan has an investment strategy, and one of my favorite investment strategies is dividend investments. And hopefully you'll learn to love dividend investing as well. Make sure you hit like and subscribe, as I've heard that's one of the best ways to grow your dividend portfolio. So the first thing I want to talk to you about is, what is a dividend anyways? Like, what does that even mean? When you buy a stock or a share of a company, you actually become an owner. And when that company increases their profits, the dividend is them sharing those profits with you as a shareholder, as a stockholder. So it's a great way to have a passive, reliable income if you pick the right companies. So let's jump into the step-by-step guide to increasing your dividend portfolio and your dividend profits. The first step is to do your research. The first thing you want to make sure is that you're picking high yield dividend stocks, but you don't want to chase yield. See, I did that when I first started. I chased yield. I was looking for these double-digit yields, and boy, were those sexy. I really wanted those, only to find out that they ended up cutting the dividend, or that they ended up stopping paying the dividend because they couldn't afford it anymore. So it was kind of like a bait and switch. It's like bring you in the front door and kick you out the back, you know? So it's like, if you're going to have a good, strong dividend portfolio, you want to have not just a high yield, but you also want to have a consistency, a track record, not just a consistency of paying a dividend over many years, by the way. You want to have a consistency in increasing that dividend over the years as well. So step one is make sure you do your research and find good, strong companies. I highly recommend you start with companies that you already know, companies that you already buy things from, companies that are big, blue chip, reliable, successful companies. That will give you the best results to start. And then as you learn to, get into the details and analyze a little bit more, you'll be able to diversify pretty quickly, which brings us to step two. Diversification. There are 11 sectors in the stock market. Now, you don't have to be invested in all 11 sectors, but as they say, don't put all your eggs in one basket. So make sure you're invested in at least more than one. That way, if you have a sector that's doing really well and a sector that's not doing so well, hopefully they balance each other out and your portfolio doesn't get affected too bad. You have maybe a really good sector that's growing and doing well, and a sector that's not doing so hot. Well, those will balance each other out, and hopefully the gains in the one will help balance out the losses in the other. If you're getting value out of this video, make sure that you hit the like and subscribe button. In fact, I'd love to hear from you. What are you investing in? What are the dividends that you like? What are the stocks that you're looking at right now to invest in your dividend portfolio? I'd love to hear about it in the comments below. Step three is to reinvest your dividends. Now, it's important that as you begin to have a significant amount of dividends, and even before you get a significant amount, that first dividend you get is kind of magical. It's pretty cool when you get that first dividend. You're like, yes, this thing works, and you're getting that money. And if you don't have a strategy to reinvest that money, you're losing out on a great way to make sure that your portfolio increases over time. Matter of fact, there's experts that say that the majority of the stock market's growth over the last several decades is in large part because of the dividends that have been paid into or paid back to the portfolio. So just so you know, the growth that you have in your portfolio might have a lot to do with the dividends that you get. So as you reinvest those dividends, it's basically the stocks producing an income for you to buy more stocks and more shares so that you can have and grow in your portfolio, which is a fantastic thing to do. And part of that actually is what's called a dividend reinvestment program, or a DRIP. It's an automatic opportunity. Some platforms have it. Make sure that whoever you're investing with, whether it's an app on your phone or whether it's a professional brokerage, that you take advantage of if they have it, their dividend reinvestment programs, or their DRIP. That way, as the dividends come in, you can actually allocate those to rebuy the same shares or the same company that the dividend came from, or you can allocate it to buy shares of different companies, maybe even in different sectors. That way you can actually have one sector helping you to diversify into other sectors. So there's some strategy there to look at and to pay attention to. All right, that brings us to step four. This is the one that I've actually had to learn the hard way. There's different companies that come and go, and they do really well for a season, and then maybe they're not doing so hot. And so you have to swap them out. Maybe you have to sell off your shares of one company because they just aren't doing it anymore, and then you have to buy into a new company and do your research all over again, start all over again. So monitoring and adjusting your portfolio on a regular basis is important. I actually had several investments with dividend paying companies that looked like they were doing great, and then they stopped paying their dividends, like, for a long time. And I was like, why this is my dividend portfolio. If I'm going to have stocks in this portfolio, I want them to be paying dividends. So I had to sell those stocks, or I felt like I should sell those stocks and those shares in order to be able to buy into a new company that was paying dividends. And so don't get too attached to a particular company or a particular stock. Make sure that it's following the strategy that you want to reach the goals that you have in mind. And if you have to sell one off to buy a new one, there's actually some tax ramifications that are there. And that brings us to our final step number 5, which is the tax consequences of dividend investing. As you have that passive income coming in, even if you have it reinvested, you might have a tax consequence depending on the stock, depending on the country, the region, depending on what type of stock it is. You might have a long-term capital gains, which is a better tax treatment or better tax problem than a regular income. So there are some dividends that will pay as regular income, or you'll have to pay taxes as regular income. And there's some that are long-term capital gains. If you put that money though into an IRA or a Roth IRA, or maybe even a 401k, any tax qualified program, you're going to actually have no tax ramifications or no tax consequences. So if you have a dividend portfolio in a qualified plan like a Roth IRA or a regular IRA or a 401k or any of those plans, you're not going to have any tax problems to worry about. But if it's in a regular brokerage firm, or if it's an app on your phone that you've kind of just opened an account and you're throwing money at it, you might have to worry and deal with some tax consequences. And you know what? We all do. They say that the only 2 guarantees in life are death and taxes. So I like the tax consequences of dividend investing. Of all the different types of tax consequences that are out there, it's not that bad when you really get into it and then you talk to your CPA or tax professional about it. So just in conclusion here, I wanted to share with you and remind you that the first thing you want to do, step 1, is to make sure that you're doing your research to get a good, strong, high yield dividend paying stock that has a consistent track record of paying that dividend and increasing the dividend over time. Step 2 is to make sure that you're diversifying your portfolio. Make sure that you're across several sectors, not all your eggs in one basket, but not too many eggs in too many baskets either, and you're diversified too wide. That's not good either. And the next thing is to make sure that you're reinvesting those dividends back into your own portfolio, whether it's into the same shares of the same company or whether you're reinvesting those dividends into new shares of new companies to continue to expand your portfolio. And then, of course, monitor and adjust. Make sure that you're making adjustments to your portfolio over time. Make sure you're paying attention. If you're not paying attention, you might have some problems. So make sure you're paying attention. And then for sure, make sure you're paying attention to those tax consequences. I hope you got a lot out of this video. Hopefully it's something you can share with your friends so that they can actually take some value from it as well. I'd love to hear from you in the comments. And if you missed the last video I produced, you can catch it here. Go ahead and subscribe to the channel up here and check out this video up here that YouTube thinks you might like. Until the next one, happy investing.